Welcome to Financial Issues, where we join reality with truth, helping you make the most of your money by honoring God with your investments. Now listen in as we give you the practical tools and advice you need to become a biblically responsible investor.
Good morning. Welcome to Financial Issues. Thanks for tuning in today. Financial Issues is a listener and partner-supported ministry, and our goal is to educate and equip the saints on the topics of stewardship, to give you a biblically responsible investment strategy and encourage you to use it, become a partner and use it. We call that defunding darkness, and to fund the light, to be a joyful, generous, and obedient giver. Today is Rapid Fire Friday. We've got a lot of questions that we want to get to that have been sent in on our website and on social media. We're going to spend a lot of time today doing that, but if you want to make sure that your question gets answered today, call us, 610-363-1110. If you're watching the live show, which happens at 8 a.m. Central Time, 9 Eastern Time today. So we'll be live here for a whole entire hour, 610-363-1110. We're going to get you in the know with some of the biggest headlines, economic headlines that have happened this week, and we'll get some encouragement from the scriptures from Romans 12:13. We did have a partner conference call yesterday, and we're waiting on compliance approval to get that posted up on the partner side. So if you missed it, just hang tight. You'll get it soon enough. Well, at Financial Issues, we help you to stay in the know about the financial issues of the day. We help to keep you abreast of what is happening in the economies and the market, and to help you keep a right perspective on it and understand how it impacts your own personal financial issues. It was a somewhat slow week from an economic data standpoint, but there were lots of things that did happen this week. So my main takeaways from the week that is ending February the 21st, 2025 are the following. Well, the S&P 500 set a new high. It keeps pushing forward. The markets, it's been a short week for the markets this week, for the equity markets and the bond market, as they were closed on Monday for President's Day. So far this week, and this is prior to the open on Friday morning, the Dow is down so far about 0.7%, the S&P hovering around the flat line, and the NASDAQ down 0.65%. So after a really good start for the markets this year, so far, all three indices, stock indices, are in positive territory. The Dow and the S&P are up somewhere around 4.2% year to date. The NASDAQ's up 3.5% year to date, but this week the markets have sort of stalled out. They have been content after fourth quarter earnings season is about wrapping up. We still got NVIDIA on deck, I think, next week. But for the most part, fourth quarter earnings season has wrapped up, and it was pretty good, with earnings coming in up around 16%. But the market is very unsure about how taxes are going to change, about how tariffs are going to impact our personal economics here, and the geopolitical issues that are happening very fast and furious. Well, the pre-markets this morning are indicating a slightly positive open for the S&P, a decent positive open for the NASDAQ, and a negative open for the Dow Jones Industrial Average. The Dow is being dragged down by the news this morning of one of its big components, United Healthcare. I'll get to that news a little bit later in the show. But so far this year, investor sentiment is pretty mixed, but it's more positive than negative. So 2 out of 3 of the most credible recent surveys that show how investors are feeling about the markets and where they are going are pretty bullish and euphoric rather than bearish. So for more of my thoughts on the markets, to go a little bit deeper, you have to be a partner. But if you are a partner, be on the lookout, I would say, probably today for that partner conference call to get posted. I did talk about that a little bit yesterday. On the employment or unemployment front, we get the weekly number out this week, just like we do every single week. Initial jobless claims rose to 219,000 from 214,000, and that was 4,000 above what was expected. The 4-week moving average is down 1,000 to 215,000. Continuing claims totaled 1.869 million, which was pretty much as expected, but still around the highest level for continuing claims since November of 2021. So I've mentioned that we will be watching to see if the D.C. Drano that's going in full force in Washington, D.C. right now will make the unemployment lines increase. The federal government is the largest employer in the country. There are 2.4 million federal workers, or of the 2.4 million federal workers, about 20% live and work in Washington, D.C., Maryland, and Virginia. So we've kind of been watching the numbers in and around those areas. Last week, federal agencies were told to fire probationary employees, and that could impact 200,000 workers if they are all let go. So recent federal layoffs under the Trump administration have significantly increased weekly unemployment claims in Washington, D.C., although the overall number hasn't been really affected much in D.C. and in nearby areas. Unemployment claims rose by 36%. For the week ending February 8th and the first 6 weeks of 2025, we saw a 55% increase compared to the prior 6-week period. So analysts attribute much of this surge due to federal job cuts, with over 4,000 workers filing for unemployment since Trump took office. Virginia, which is in the area, in the proximity of Washington, D.C., experienced a 12% rise in claims, and Maryland, which is also close to the proximity of D.C., saw a slight decline. Outside of the D.C. Drano story, unemployment remains pretty much, the employment picture remains pretty much the same, with a low level of firing outside of the federal government and a more subdued pace of hiring. DOGE Dividends has been a big topic of discussion this week. I talked about it on the show yesterday. But, my general consensus is that it doesn't matter. One argument is that this money should be returned to us because it was taken wrongfully under the Biden administration. Whether it was collected wrongfully or not, the bottom line is the federal government doesn't have the funds to send back. So Trump was handed, whenever he took office, a country that is spending $2 trillion a year more than it is bringing in. The simple facts of this is that whenever you have a shortfall in revenue and you still have to pay for things, you have to borrow the money that you don't have to pay for the things that you want and need to pay for. So even if Elon finds $1 trillion in savings, we still have $1 trillion in negative income. You can't pay you can't pay dividends if you don't have the income to do it unless you borrow the money. So if we get that DOGE dividend, the government will still have to borrow that money to send it back to us. So this idea has been a great conversation starter to sort of jumpstart the American taxpayers give a dang about the way that taxes work. So I think for the time being, we just really don't need to spend that $5,000 that we think we might be getting back. We want to table this idea until we at least get to a surplus budget. After all, taxpayers have been sort of complicit. We've been sort of complicit in all of this, assuming that we had free and fair elections, because we have allowed the politicians and Congress to spend us into the $36 trillion in debt that we currently have on the books, and we've allowed them to spend $2 trillion a year more than they brought in. Or, hey, here's a novel idea, which I think Trump pounded the tables on when he was on the campaign trail. How about they just don't take it from us in the first place? And that concept is called lowering taxes. So, let's focus on growing the economy to boost tax revenue in legitimate, healthy ways. get people working because companies are thriving. People and companies making more money equals a bigger tax base. A bigger tax base without even increasing the tax rate means more tax dollars. So the Fed released their minutes from their most recent meeting. It's not really new news. The Fed is pretty intent on a pause, but it is still in an easing. It still has an easing bias, and it started this easing cycle. So they mentioned backing off on quantitative tightening until government debt ceiling drama eases. So hear the music. That means we got to take a break. I have more to say about this. So we're going to take a break. We're going to come back. I'll finish up my thoughts. I'll finish up getting you in the know, and then we'll get to some of the calls and questions. 610-363-1110 is the number to call if you've got a question.
Navigating through investment options can be challenging, especially when you're determined to uphold your God-given values. Every dollar you invest is a vote for the world that you want to live in. Let your values guide your investment decisions and help to shape the culture in which we live. Become a beacon of light and pave the way with biblically responsible investing. Timothy Plan, where faith and finance collide. Before investing, carefully consider the fund's investment objectives, risks, charges, and expenses of the investment company. This and other important information can be found in the fund's prospectus. To obtain a copy, visit timothyplan.com or call 800-846-7526. Read each prospectus carefully before investing. Investing involves risk, including the potential loss of principal.
My name is Reagan Gardner, and I am in the 4th grade. Last year, I wanted to be like everybody else. I thought I had to act different, look different, and be different to be cool. When I joined Crossroads, I learned that God loves me just the way that I am.
Help reach more kids like Reagan with the hope of the gospel. To learn more about Crossroads Kids Club and how you can get involved, visit reachourschools.com.
Through the ministry of Preborn, the Financial Issues family has saved tens of thousands of lives of babies. What an amazing job that God has done through you, the Financial Issues family. Would you join us in saving the lives of babies? What an amazing reunion we will have in glory, meeting all the people that we have saved. Please go to preborn.org, that is preborn.org, or financialissues.org, and click on the Preborn banner.
Securities offered through G.A. Reppel & Company, a registered broker-dealer and investment advisor, member FINRA and SIPC. Opinions expressed by Shanna are hers alone and are for informational purposes only and do not necessarily represent those of G.A. Reppel or the outlet on which you are listening. You should consider how the information applies to your situation prior to personally implementing it and consult any financial professional you work with to make sure it's applicable to your financial plan.
Welcome back to Financial Issues. Well, my slow Texas drawl has prevented me from getting everything I wanted to say in that first segment there. I guess I just had way more to say than I thought I did.
But the drawl is charming.
And Shanna, it is my opinion as well that the slow Southern drawl will be the dialect of heaven. You know, it's probably not going to be the Philly accent that we have here, right, Sam?
I have the Western New York accent, so I just speed through everything I say.
I don't know.
Rochester in it.
I was kind of looking forward to hearing Dan's accent when we get to
There you go.
All right, let's get back to it real quick. So this week, the minutes of the latest FOMC meeting were released. There was not really much new. You know, the Fed did indicate that the debt's still good, but, they're sort of on this pause, possibly through into the second half of the year, but they still are in an easing cycle. And there was some language in there that indicated that they do want to continue easing. The interesting part of it that we didn't hear a lot about in the press conference the reports to Congress was the part about backing off on quantitative tightening until the government debt ceiling drama eases. So quantitative tightening is tightens access to capital because it lets debt roll off of the Fed's balance sheet. So what happens is they have bonds that are coming due. When a bond comes due, the person who, or the entity that borrowed the money, pays off the debt, which means that the government pays the Fed, their bond comes due, and they don't have to pay the interest anymore. So forcing the government to actually pay off debt rather than just reissuing it. When they don't let it roll off, they just say, well, this is due, but we're going to let you borrow it again. We're just going to issue another bond and you'll just keep paying us interest at whatever the new rate is. Well, because we have a budget deficit, the government still has to borrow money, as you heard me talk about in the first segment, from somewhere to be able to pay its obligations. You know, the Treasury General Fund, there's a bank account for the Treasury, and it has to have money in it for all of these payments that we're hearing so much about to be able to go out. So that is... I know we do have a follow-up question on that. Maybe we'll get to it a little bit later. But what's coming next week is the PCE data. So the Fed's preferred measure of inflation is going to be reported next week, along with personal spending and personal income. Now, I won't be here to take you through those numbers because I do have a vacation next week that I'm very excited about. But Seth, don't worry. Seth is going to be here. Seth, you want to tell them what to expect next week?
Yeah, I'd be glad to, Shanna. So we'll be keeping things afloat here. Sam and myself be looking at some of the big news headlines, trying to make sense of them as best we can also. And we'll get some good, teachable moments in there as well. So even though, Shanna, you won't be here with us, you'll still be hearing Shanna's voice on the show, which will always be great. So yeah, looking forward to that next week, Shanna.
Sounds good. And me and Jason will be here on Monday.
Yes, that's right. Yep.
To go through some things.
Looking forward to that too.
Yep. Now that you're in the know about the recent and upcoming financial issues, we hope that you're going to learn more about how we can help you integrate those issues into your own stewardship. So find out more about how you can defund darkness with our biblically responsible investment strategy. You have to become a partner to do that. And while you're there, you'll be able to listen to the latest partner conference call as soon as we get it approved and up in posted. So
awesome.
I think we had a follow-up
Yeah,
question.
we did here, Shanna. Let's start. So Philip asked this question on Facebook earlier this week, and he said, Shanna, I heard an economist recently explain why the interest rates are going up despite the Fed rate cuts, and didn't understand her economic talk from this particular economist. Could you explain it so I can understand, since you have the heart of a teacher? What would you have for Philip, Shanna?
Well, I'll give it a try here. So the Fed sets the rate that banks loan to each other in the overnight market to make sure that the banks meet reserve requirements. So the government sets reserve requirements, says that at the end of the day, banks have to have so much money in their reserves, and if they don't, they can borrow from each other or from the Fed to make sure that they have that. And so the FOMC sets that overnight rate. We call that the short rate. So short rates can move up and down in response to monetary policy, the Fed funds rate. So the Fed fund rate is going to more heavily influence CD rates. That's why we've seen CD rates drop as the Fed has cut rates. It's also going to have a bigger impact on shorter term loans like car loans, money market rates, and different things like that. But because the Fed funds rate, the banks use the Fed funds rate to set their loan rates to each other and to consumers, the movement of interest rates that the Fed controls only impacts the short end of the yield curve. So long-term rates, now we're thinking mortgage rates. That's why mortgages in the housing market is still under so much pressure. But long-term rates move less directly with the federal funds rate. Like if you see the Fed funds rate get cut like it did, we actually saw a spike in the long end, and that's due to some different factors that aren't really much under the control of the Fed. The good news, though, is that you hear Treasury Secretary Steve Bessent right now talking about the importance of getting that long end under control. And I think there's more things that that can be done from that side than from the side of the Fed. The Fed really has a couple of really blunt tools to work with, and they can only do what they can do. And moving long rates isn't something that the Fed can very easily do. So long rates move less directly with the federal fund rates due to, and this is really, in free markets, it all has to do with supply and demand. So supply and demand for U.S. Treasuries are going to influence the longer-term 10 and 20 and 30-year rates. For example, if the government spends a lot of money and issues a lot of debt, the supply of bonds goes up. If demand stays the same, if there's the same number of buyers and they don't want to buy any more of that debt, you have less demand. The price of that debt goes down, and that means the yield goes up. So rates go up, prices go down. There's an inverse relationship there. That's the way that bonds work. So earlier in this week, the U.S. Treasury yields pulled back a little bit because like I mentioned earlier in some of the Fed minutes, they indicated their willingness to pause or slow quantitative tightening. So that means instead of letting debt roll off their balance sheet, taking supply off the market, they're going to be buying new debt to replace the debt that's maturing. So they are willing to keep rolling the printing press, allowing the U.S. to borrow and increasing the supply of debt that buyers could buy in order to fund the deficit spending that Trump inherited. So yesterday, Treasury yields pulled back a little bit more. As we heard from Treasury Secretary Scott Bessent, he said that any move to boost the share of longer-term treasuries and government debt issuance is in some ways off the table. So demand for the U.S. staying strong means that the government doesn't have to pay higher rates to attract borrowers because of their debt. So if borrowers, the ones that are buying the U.S. debt, become more concerned about the U.S.'s ability to pay the interest that it has promised to pay or to pay the debt back when it comes due, then buyers of the debt are going to require a higher yield, because they perceive an increased risk. So as people around the world are seeing what DOGE is revealing and seeing how bad of stewards our U.S. government has been, that can create a little bit of uncertainty. Although I think that the confidence in the U.S. government to pay back their debt is still pretty strong. Equity attractiveness also plays a role in influencing long rates because it impacts the supply and demand. So if investors can get a really great rate, if the markets are doing good like they have been, the S&P returning 20% plus returns over the last 2 years, if investors are looking at that kind of return versus the 4.5% roughly that they can get in a U.S. Treasury, equities look way more attractive, so there's less demand for bonds. Bottom line is that excess supply in the Treasury markets, in the bond markets, make prices go down and yields go up. Excess demand, so when let's say that the stock market starts to look unattractive, well, at that point, people start selling their equities, and you hear about this flight to safety. They want to buy the bonds. They'll accept a lower rate because they think that there's maybe some negative returns coming in equities. So excess demand for bonds will make the prices go up, basic supply and demand, and when prices go up, yields go down. So that certainly wasn't a Rapid Fire Friday answer, but I think it was sort of a teachable moment. I hope I made it make sense.
Yep, that's awesome. Thanks, Jenna.
Well, the Dow pre-market is under pressure. It's indicating an open of down 0.5 point. And the reason for that is that the news that's coming out about United Health has initiated a civil probe into United Healthcare. to see if they have been pushing doctors to add extra diagnoses to get extra payments from their Medicare Advantage plan. I don't know if you remember, but in the last several months, there was a big story. The CEO of United Healthcare was murdered in New York City by someone who was very disgruntled about their claims practices, or allegedly. I don't know that that's actually been resolved yet, but that was the news that came out. So, what if your doctor, now you think, what can I do about this on an individual level? What if I'm on one of those Medicare plans and maybe my doctor is making up, adding some diagnoses to get paid more from Medicare? So what if your doctor just figured out your diagnosis and treatment plan without being worried about how much the insurance company will pay them? Well, that scenario does exist. You could look to a health sharing ministry like the one that we use here at the ministry, Samaritan Ministries. You can find out more information about how that might be a good alternative to healthcare for you and your family. Well, folks, if you're listening on an outlet that carries a short version of the show, we wish you a farewell and a good weekend. Everyone else, hang around. We'll be back with Rapid Fire Friday.
In the last 10 to 15 years being in ministry, being married, something that has been constant in our lives is Samaritan Ministries. As we've moved, we've had babies, we've had different things come up, we have just been able to rely on Samaritan in ways that we never really even thought about before becoming members.
Our heart's desire is to plant roots and be in a place for a really long time. It's how we were raised. We see the benefits of that, but we also see the open-handedness of being used by the Lord wherever He calls, because we just assumed when we started pursuing church planting, the quickest way to get from point A to point B is a straight line. And with the Lord, sometimes you find out it looks a lot more like this. And yet, Samaritan was with us through the entire thing.
We didn't have to look into, we have to change insurances now because we've moved states or whatever the case may be. And it's just been a real blessing to us in different phases of life.
I'm Kyle.
I'm Colleen.
And we're the Gen X.
And we're Samaritan members.
I just love the first book of Exodus. The king says the Jews are too many. Get rid of them. I command you to kill the firstborn. But the midwives to the Hebrews heard the order, and what did they do? They defied it. And God dealt favorably with the midwives and gave them families. He blessed them for loving life. He blessed them for saving babies. We have re-entered the death cult in this country. You think about how much we elevate death, whether it be the chopping off of parts and we call it transgender care, whether it be shouting our abortion, and you see it so beautifully in John 10:10. It is the divide of the entire scriptures. Now, most people would say John 3:16, but think about it. The enemy has come to lie, steal, cheat, and destroy. I have come to give life and life more abundantly. That's the whole ball game, everybody. It is everything. And we have to have the joy of Jesus Christ to enjoy life and to protect it. It's a gift from above. And Preborn is leading the charge.
Pharrell came to Crossroads as a fourth grader. His name had been brought to my attention by the school principal. She was concerned about the direction he was heading.
I remember I wasn't the best kid. I got into trouble a lot.
He became a very active part of Crossroads Kids Club.
Mr. Engel, he was the leader that really impacted my life in so many ways. I honestly didn't want Crossroads to end.
We would invite all the students to come to our youth group here at Waterfront.
I felt God saying, come on, come to me. It felt like I was set free.
And I'll never forget the day when we had the privilege and the honor to baptize Pharrell.
I hugged Mr. Engel. I don't know if he understands. I'm truly, thankful to have him through the whole journey. If it wasn't for Crossroads, I probably wouldn't be in the place that I am right now. I wouldn't be a follower of Christ.
Help reach more kids like Pharrell with the hope of the gospel. Visit reachOurSchools.com.
Welcome back to Financial Issues. Thanks for tuning in. We're going to get right to Rapid Fire Friday. We've got some callers in the queue. If you want to get your question queued up, the number 610-363-1110. Let's go to Joe. Joe's calling from Kansas. Hi, Joe. You're live on Financial Issues.
Well, God bless you all, and we appreciate all that you do and all your hard work, and you certainly are deserving of a vacation break.
Thanks, Joe.
You're very welcome. My question goes back to MA5, which we talked briefly yesterday on the phone. My question is, as an ETF, should that go into a Roth or a brokerage account? And because you've many times talked about tax efficiency when it comes to ETFs.
Yeah, so I think that this is. I think this could go in either. I think what's going to dictate where it goes is where you have the money available to buy it or where you can free up money to buy it. So I do think that it is a growth investment. But let's just say that I only had 10% of my investments in a Roth account. Well, I would rather have all of my technology holdings in my Roth account. That just necessitates putting it somewhere else. So, it is going to be considered a growth in the growth category. So either of those two, I think, would be fine. If I had equal opportunity to either put it in my taxable account or in my Roth account, I'd probably choose the Roth, but not at the expense of technology. So if I only had enough room to put my technology stocks in my Roth, all of my technology stocks would go in my Roth.
Okay, great. All right, that's a good answer, and I thank you for that. Can I just sneak one other one in here real quick?
Sure.
Okay. Over the last few months, we've had a lot of equities available with high dividends between like 5% and 14%. Now, those, I imagine, should be going into the Roth.
Which ones now?
Oh, equities that have been having a lot. Well, most of them, I guess, were RITs and financials, and they had great dividends, anywhere between 5% and 14% dividends.
Yeah. So your dividend paying stocks, I would rather see in your IRA. So your income producing assets. I know that the financial, I can think of one that is that has the highest yield there. The way that is structured is it's not structured really for much growth. It's structured to pay out most of what it gets in the form of a dividend. So I would put my income paying investments inside the traditional IRA, the high growth ones inside. And growth stocks are going to be really characterized usually by the lack of dividends, because when a company is growing, when it's in the stage of growing the fastest, it's allocating capital to reinvest back in the company to finance its growth. Once the company gets mature, once they get a big market share, once they kind of, their growth really slows because they've kind of, maxed out their market share, but they're still running a good, successful plan, they start to return value to shareholders in the form of dividends. So the high income producing, the biggest paying dividend stocks and all of your fixed income, I would place first in the traditional IRA.
Okay, thank you so very much. I'm sure other people have definitely enjoyed those answers.
Okay. Thanks, Joe. Those were great questions.
Yeah, excellent questions, Joe.
All right, God bless you.
God bless.
God bless you, buddy. Hey, Shannon, can I jump in real quick here and just say the partner conference call is now posted. So if anybody missed it yesterday, feel free to go listen to it after the show, of course.
Yep, good stuff there. So
awesome.
I felt good about it anyway.
yeah, there you go. No, it was great. Really, it would be good for you to go back and listen to it, folks, who do get a chance to. So,
yeah, I would say as a partner, even if you can't listen to the show every day, I think that's fine. I think you can still do the strategy. I think the necessary thing, if you want to be a partner and you want to manage your own account, it's spending maybe 5 minutes reading the weekly commentary that typically gets posted, I would say by sometime between Monday evening and Tuesday afternoon. Read that every week and make sure that you tune into the partner conference calls. And, it doesn't have to fit into your schedule because we do post the conference calls and leave them up. They're usually right at an hour long. So, running kids back and forth or running errands, making road trips, going to the grocery store, going for a walk. And the cool thing about the way that we deliver content here at Financial Issues is that you can get some of it live and you can get some of it when it's convenient. Well, you can get all of it when it's convenient for you. So those are the two things that I would say. And to check your emails to make sure that you're getting any cell alerts that we may send out. But you could also get in the habit when you go in to read the weekly commentary, give yourself an extra 5 minutes and just go look at the alerts tab and make sure that there's nothing new there that you didn't see. So, that's kind of the backup for that. We send it out by email. If you miss it in your email, you don't get it for some reason, you can always log in and go check the alerts tab. So, good things there.
Yeah.
Let's get to Maynard. Maynard's calling from Ohio. Hi, Maynard. You're live on Financial Issues.
Hi, Shanna. My question is about MA5 as well. I've started to buy some and doing some more research. What I've found that the holding company is a foreign company, and so the website says that you have to. It requires a timely filing of a QEF form for your tax return, which is part of the IRS form 8621. Is that something we have to file every year, or is that just when we take a distribution?
Now, when you say the website, which website are you referring to?
This is the company's website itself. They're just reading through. I just went to I can say the name if you want, but it's just their name.com. And it talks about that because of this is normally taxed as a collectible tax rate, and to get by filing this form, you can get it taxed as a capital gain instead of a collectibles tax rate, which is less.
So I do see some different information out there. So because I'm not a licensed tax professional, I could get myself in some hot water by giving tax advice. What I would do is refer you to your tax professional. So, I do know that the company is set up to issue a 1099, which would which could potentially alleviate some of those issues. But what I would say, just to be sure, is to ask your tax person.
Okay, and the other thing is, if it's in a Roth, it's growing tax-free anyway, correct?
Yes.
Yeah, so if it's in a Roth, then that should be...
It could be. There are some investments that even if you hold them in an IRA like MLPs, you may have some tax considerations. But, all in all, we looked at the impact, and we think the impact we think the advantages outweigh any potential disadvantages from this. But I think it's a really good idea to understand how it's going to impact your own personal return.
Yeah, so that was I started buying it, and then as I looked more, I thought, I do have someone that does my taxes, but they have limited. Their knowledge is is limited in certain respects. Okay, that's it. I will contact them and see if they can answer my question on that as well. Thank you. Thanks, Shanna. And hey, God bless you with a great vacation.
Thanks, Maynard. I appreciate it.
All right.
Thanks
Shanna.
for calling. Great question.
Thanks, Maynard.
All right. I think we're past time. So we're going to skip the ag today, but it will be on our website. Seth, tell them where they can find it.
Yep, you guys can find it very easily. Actually, the best place to go, you can find it on the website, financialissues.org. You can also, this is a great reason to get the FISM app. That's probably the easiest place to get it. If you download the FISM app, go to the Financial Issues tab and you scroll down a little bit. The ag report's right there. It's updated frequently, so you can get it as it comes out. But that's where today's ag will be.
Yep. Good stuff.
Yeah.
We have time to get anything.
We might have time for a quick one here, Shanna. Jan is owning a specific type of ETF and is wondering, speaking of MA5, if she should replace it with MA5 or if these are just too similar to leave it alone. What do you think?
Where are we?
We're down a little further on Ask Shanna there.
Say that again. She's got MA5.
Yeah, so she has MA5. She wants to replace it with another very similar ETF. And you can see that in the question there. And just wondering if they're too similar, if she should leave it alone or replace it.
They are very similar. So she's got something that's not on our list.
Right.
And she wants to know if she should replace it with MA5 that is on our list. So they are kind of similar. They are a little bit different. If it were me, it's going to, you're going to have to look at your capital gains situation and all of those kind of things. I probably, if I were a partner, would replace it with what's on the list. That way I would know if there came a time to sell it because of a sell alert. If you don't have something that's on the list, we're not ever going to tell you to sell it. So, because we don't follow it. That might be one consideration. Got to take a break. We'll be right back.
It's up to us to stand up and say, enough is enough. All of this unbiblical stuff that's going on, whether it's abortion or transsexual or LGBTQ, widespread pornography, human trafficking. Bottom line, it's still up to us. If we stop investing in these corporations that are trying to destroy us, sooner or later they're going to wake up.
To learn more about biblically responsible mutual funds and ETFs, go to timothyplan.com.
Hearing Jesus say, "Well done," how to secure your rewards in heaven. Don't you want to be sure that when you get there that you're going to have the best life forever? And that best life forever is being able to access the plethora of wonderful escalating rewards that are elucidated throughout the book of Revelation to those who overcome. Well, that's what the book's about, friend.
Order your copy of Hearing Jesus Say Well Done today on Amazon and start living for what truly matters.
What separates Crossroads Kids Club from other ministries to reach school-age children? What sets you guys apart?
First of all is our connection with local churches. We mobilize, equip, train, support local church partners. We're right inside the schools. There's a number of ministries that try to serve public school children outside of the school, but we're able to be right there on the campus. Another key thing is just our values. Our highest value is actually relationships. And so we're not a ministry that's driven by a lot of fancy technology or flashy stuff, but rather getting adults who love Jesus and who love kids to sit on the floor with a group of kids, to listen to them, to love them. So I would say the relational emphasis and the simplicity of the model is actually something that makes Crossroads special as well.
Help reach kids with the hope of the gospel. Visit reachOurschools.com.
The opinions and recommendations expressed on this program do not necessarily represent the opinions of the station or any of the program sponsors. Additionally, all products or services offered by the program sponsors may not be known by the program.
Welcome back to Financial Issues. Man, this is a Rapid Fire Friday show, not because we're answering a lot of questions, but because time is flying, I guess. Well, more news out this morning is news on a company called Coinbase. So Coinbase is in the crypto industry. So, one reason that we've been hearing that the economy could soon be firing on all cylinders again under a Trump administration is because of decreased regulations. Well, that's sort of a vague statement, but here's an example. Here's a real-life example. So Coinbase announced on Friday that the Securities and Exchange Commission, the SEC, has agreed to drop its enforcement case against the company pending approval of the regulators' commissions. So the SEC is the investor watchdog agency. So when companies want to go public, they have to file all of their information with the SEC. The SEC has to approve it for them to become a publicly traded company, one of the functions of the SEC. So when Coinbase went public, the SEC did their due diligence and they approved their filing to go public. Under the Biden administration, under the lead of Gary Gensler, the SEC brought a case against Coinbase with accusations that they were operating as an unregistered securities exchange. So alleging that crypto were securities and not currencies or commodities. So since that case has been brought, Coinbase has spent upwards of $50 million fighting the SEC case or defending themselves against this case. And now the case will probably just be dropped. No fines, no admission of wrongdoing, which kind of implies to me, I mean, if I was Coinbase, I'd be really hot because it implies that there was no merit to the accusations in the first place. And now they've spent this $50 million to defend themselves for not doing anything wrong. So this is how excessive regulations by government agencies cost companies real money. And when it costs companies real money, the owners of those companies suffer. So who are the owners of publicly traded companies? They're the shareholders. So, you know, it's kind of ironic that the agency that is supposed to be protecting investors and shareholders are now harming them in this way by these excessive regulations and grabs for control. So I'm excited to see that things are a-changing indeed. Well, where do we go here? Let's get to Robert.
Yeah,
huh?
I think Robert's ready.
Okay.
Yeah, let's do it.
We've got Robert on the phone from South Carolina. Hi, Robert. You're live.
Hey, Shana. How are you?
Good.
I just have a question about the asset allocation model. A while back, we got the new ones coming out, but in the future, a while back you said that energy was going to be higher in the model. I'll be in the middle model on the new diagram. Is that correct? Because it's 5% where I am right now, and I'm about 7.5%. Mm-hmm. Do I need to cut that back?
No, I wouldn't. I would wait. So that's going to be where you are now is probably pretty close to where we want to be.
Okay, praise the Lord, I call.
Good call, Robert.
To sell out and buy something else.
I hear you. Good call, Robert. Okay. All right. Great rapid fire Friday question. You
Thanks,
as well.
brother. God bless, man.
Bye-bye.
It's always good to hear from Robert, Shanna. That's fun.
Yeah.
We got some more questions here if you'd like to get to these, Shanna.
Let's do it.
Brandon, youngster. Good to see Brandon again. He's 24 years old. He's saying, I'm just wondering if you have a timeline on when the new asset allocation models will be out and how I should treat placing new money in the meantime, knowing that my model will likely change. I'd prefer to not place money in a sector and then instantly be overweighted when the model does change. Do you have any advice for me on this?
Yep. He's thinking just like Robert, I think.
Yeah, that's right. That's right.
I did address this on the partner conference call yesterday, so I gave a little bit more on the timelines. In the partner conference call, I laid out the three models that we're going to, and I think the important thing right now is that people start to understand what the models are going to be and then decide where they fit, where they're going to fall. I think it's going to be much more streamlined. It's going to be much easier to discern which model that is going to be best for you. So, I mean, Brandon's 24, so I'm just going to go out on a limb and assume that he's going to be in the growth model. I mean, I could be wrong about that. But, the growth model, I would focus right now on increasing your technology holdings. Unless you're upwards of, say, 25%, then don't increase them. But I wouldn't imagine that you would be that high based on the current allocation. The growth model is going to eliminate fixed income altogether. So it's going to be 100% equity strategy. So if you have the risk appetite to be 100% equity, then if you do have some fixed income holdings, you could start to eliminate those. Technology is going to increase. Everything else, we're going to try to get those new models posted to the website. There's just a real challenge in getting the asset allocation models from the 5 that we have now down to the 3. It's going to cost a lot of man hours and things like that to use the system that we have, and we're so close to just getting the new website released that we're just going to, we're trying to come up with a workaround to get those out to you.
Awesome, Shanna. That's good stuff. Clint is up next here. He's 54, and he's saying, I started building a 12-month CD ladder last year. I heard you say the timing for this has passed. What's a good alternative to a CD for money I have in a business bank account that I need to keep in the business name to avoid distributions? I was looking at T-bills, and it looks like they are sold once a month for 12-month bills. The bank's currently a 3.75 APY for a 12-month CD. Should I just stick with that for simplicity? Again, Clint is 54.
Yeah, I think that's a good alternative. What I'm gleaning from the question is business account. I'm assuming that the purpose of it is for, to fund operations. So it could be money that you would need to spend. I certainly wouldn't consider investing it if you think that you might need it in the short term. FX3 might be a good option for you. The yield is a little bit south of 5%. Right now. So I would expect that if and when the Fed gets back into cutting rates, that the yield on that is going to go down as well. But it's kind of an easier way. There's less maintenance than doing a CD ladder where you have to reinvest, manually go in and find new CDs every 6 months if you built that ladder. So it's a little bit hands-off way. There's not been historically a lot of volatility with that holding, and it currently is giving a good yield. So FX3.
Awesome. Good stuff, Shanna.
All right. Well, let's transition to our encouragement from the scriptures. Our stewardship verse of the day today comes from Romans 12:13. Contribute to the needs of the saints and seek to show hospitality. Well, one of the main themes in Scripture is that God is love. At the moment, when we recognize our fatal flaws of sin that we have in our own lives, and we yield our own will to God's will, and we make Jesus Lord of our life, we repent from our sins, we are given salvation, and we are filled with the Holy Spirit as a deposit. Well, the Holy Spirit is God, the Scripture tells us, and God is love. Love is patient and kind and giving. After all, God gave His only Son. So when we model our own lives after God, one thing that we do is to give. When we share what we have with others, we are giving love. Giving love to someone is giving them God, because God is love. So the command to share with others and make provision to meet others' needs isn't about redistributing wealth. It's about sharing the love of Jesus so that others can come to know God like we do. We can wrap our brains around this truth. Giving, the whole concept of giving, takes on a whole different meaning. What do you think, Seth?
This is great, Shanna. This verse, I think, really, when we're talking about giving and generosity, it highlights a concept that we don't often think about, I think, in the scriptures, especially in the New Testament, which is that for Christians, our top priority for our generosity actually should be fellow Christians. It should be the church. It should be believers. That goes for contributing to the needs of the saints and generosity, and also showing hospitality too. I think we often miss the fact that hospitality, welcoming people into your home, being kind to them, giving them almost like a second home in that way, and that could just be having someone over for dinner. That's a wonderful way to show generosity too. And we don't often think, hey, this is a way that I can do this. So yeah, I'd encourage all of our listeners, if you have the house to be able to do that, consider doing that. Absolutely.
That's encouraging, Seth. I'm building a new house.
Yeah, yes.
I'm going to have you guys over for dinner.
Absolutely. Show hospitality to the sage, Shanna. That's right. It's not long. It's a short walk,
It's a short walk.
That's right.
Well,
that's
folks,
good stuff.
I hope that you have learned something today. I hope that you have been encouraged. And I hope that you will share what you're learning on financial issues with your friends and family. So Lord willing, we're going to be here again next week to continue to remind you that the Master's coming back. Everything that we have belongs to Him. We're going to be asked to give an accounting of how we handled that time, talent, and treasure that we were trusted to manage. We're here to help you be found a good and faithful steward in everything that you do. Check us out in the meantime at financialissues.org. And if you're a partner, listen to the partner conference call. Have a great weekend, and we will see you again next week.
If we ever forget that we're one nation under God, then we will be a nation gone under.
Thank you for joining us. This has been an FISM production.